25th. Sure don't want to go back 20 days. Sure. I know that Public Health and Welfare ran over a little bit, so Senator Hildebrand should be joining us. I believe that we have Senator Dietrich online, and so we are all present and accounted for. Please note that in your folders, Senate Bill 322 plus the fiscal note, Senate Bill 331 and Senate Bill 334 have been added. At this time, I'm going to open it up for bill introductions. Lee?
Thank you, Mr. Chairman. Lee Mellis, Kansas Insurance Department would like to request introduction of RS 2824. This deals with the permanent elimination of the statutory transfer related to securities fees.
Thank you. Committee, are there any questions? Is there any objection? Seeing none, your bill will be introduced.
Thank you, Mr.
Chair. Very much. Are there any additional bill introductions? Okay, seeing none, we will move on to the hearing on Senate Bill 336. I will open that hearing, and Eileen, would you give us a bill overview?
Thank you, Mr. Chair and members of the committee. Senate Bill 336 amends KSA 42B06 and 42B07 relating to limitations on permissible investments made by Kansas domiciled life insurance companies investing in equity interests and preferred stock. Section 1 amends KSA 4022B06 pertaining to investments in preferred stock. Under current law, a Kansas life insurance company may invest up to 25% of its admitted assets in preferred stocks of or stocks guaranteed by a corporation incorporated under the laws of the United States of America or any state, district, insular, or territorial possession thereof, or of the Dominion of Canada or any province thereof. The life insurance company's admitted assets are based upon the company's last annual report as filed with the commissioner, or a more recent quarterly financial statement filed within 45 days of the end of the quarter to which the statement pertains. Subsections A through E of Section 1 are all requirements that current law places upon any potential investment made by that Kansas-sized life insurance company in the preferred stock of the American or Canadian corporation. Senate Bill 336 would amend the statute by removing all of those requirements placed upon any such potential investment. Section 2 amends KSA 42B07 pertaining to investments in equity interests. Under current law, a Kansas-sized life insurance company may invest up to 15% of its admitted assets in the equity interests of an American or Canadian business entity. As with 40-2B06, the life insurance company's admitted assets are based upon the company's last annual report or the more recent quarterly financial statement. Subsections A through G place requirements on any potential investment made by such life insurance company in such business entity. Senate Bill 336 would remove the requirements in subsections A through D. The bill would also decrease the amount of the life insurance admitted assets used to invest in the outstanding equity interests of any one business entity from 5% to 2%. Finally, the exception to subsections B and D provided in subsection G has also been removed. Finally, I corrected 2 unlawful delegations of legislative authority. Each statute stated that the filing of a financial report with the commissioner would be made on a form prescribed by the National Association of Insurance Commissioners. And essentially, the legislature cannot delegate its legislative powers to other entities. So I corrected that issue by requiring that the filing be made in the form and manner prescribed by the commissioner in rules and regulations. And that power has been granted by the legislature to the commissioner in KSA 40-225. If you're really looking for the details, I provided that in footnotes at the bottom of the brief, and the bill would become effective upon publication in the statute book. And with that, Mr. Chair, I can stand for questions.
Eileen, thank you very much. Committee, are there questions of Eileen? Senator Gossage?
Yes, Eileen. Well, perhaps this is not to you. It's regarding the fiscal note.
Not to me, ma'am.
Okay. Thank you.
Any additional questions for Eileen? Seeing none, thank you very much. We will now turn our attention to the proponents. We have Chris Swickert with Vice President and Associate General Counsel for Security Benefit Life Insurance Company. Welcome, Chris.
Good morning. Mr. Chairman, members of the committee, thank you for the opportunity to be here today. My name is Chris Swickert. I am Vice President and Associate General Counsel of Security Benefit Life Insurance Company, and I'm here to testify in favor of Senate Bill 336. If approved, this bill will modernize Kansas statutes that govern the investment by life insurance companies in preferred stock and other equity interests, and in doing so will help Kansas insurers grow their businesses, serve their customers, and compete more effectively with insurers from other states. I'll start by outlining the current statutes, KSA 42B06 and KSA 42B07, what they allow with respect to preferred stock and other equity interests, and then I'll discuss how the bill would amend the current statutes. KSA 42B06 allows Kansas life insurance companies to invest up to 25% of their admitted assets in preferred stock, but only if a lengthy list of conditions are met. And those conditions are set forth in detail in Appendix A of my testimony, and I'll just summarize a couple of them here now for the sake of brevity. The first requirement would be that obligations of the issuer must be rated investment grade or satisfy other tests set forth in the statute. The issuer must not be in arrears on dividends or must have paid full dividends over the last 3 years, depending on the type of preferred stock issued. The issuer's net earnings to fixed charge ratio must be at least 1.25 times for the most current recently completed 3 years, and the issuer must have been in existence for at least 5 years. Turning to KSA 42B07, it allows Kansas life insurance companies to invest up to 15% of their admitted assets in equity securities separated into 2 different categories or buckets, if you will. The first of which is it permits 7.5% of admitted assets to be invested in unlisted equities or listed equities that don't meet a lengthy list of requirements that we'll get to here in just a moment. The other 7.5% it permits to be invested in listed equities, but only if a list of conditions similar to the conditions in the preferred statute are met. And again, those are set out in detail in Appendix A of my testimony, and I'll address a couple of them here. A requirement that the obligations of the issuer must be investment grade or satisfy other tests set forth in the statute. The issuer must have paid cash dividends in each of the last 3 years and had earnings in 3 of the last 5 years prior to the date of the investment, unless the issuer satisfies certain net assets, net worth, and aggregate market value tests. And then finally, the insurance company can invest no more than 2% of its admitted assets in any one issuer, nor can it acquire more than 5% of the outstanding shares of any one company. We believe that the existing statutes, their limitations, restrictions, and requirements are outdated, cumbersome, overly restrictive, and difficult to use at a time when yields on high-grade debt and high-yield debt are at all-time lows. When we compare the Kansas preferred and equity statutes to a number of other states, including states that have a larger number of insurers than Kansas does, we find on the whole that their statutes are more flexible and allow a greater percentage of an insurer's admitted assets to be invested in preferred stock and other equity interests. And those other states' requirements are set forth in Appendix A of my testimony as well. So the bill before you would amend KSA 42B06, the preferred statute, to allow Kansas life insurance companies to invest up to 25% of their admitted assets in preferred stock, so no increase in the overall percentage. But it would eliminate the additional requirements set forth in the current statute, which I've summarized a moment ago. The bill would also amend KSA 42B07 to allow Kansas life insurance companies to invest up to 20% of their admitted assets in equity securities, so a slight increase over the current 15%, but would eliminate the list of additional requirements that we walked through just a moment ago. However, it would maintain the requirement that no more than 2% of admitted assets be invested in the equity securities of any one issuer. We believe the revised statutes, if adopted, would provide Kansas life insurance companies a more current construct with appropriate guardrails, permit Kansas life insurance companies to more readily adapt their investment portfolios to market conditions as needed, allow Kansas life insurance companies to grow their businesses, serve their customers, and compete more effectively with companies located in other states with less restrictive statutes than the Kansas current statutes do. States such as Oklahoma, New York, Louisiana, Connecticut, Michigan, Pennsylvania, and Texas. And again, Appendix A has some comparisons between the requirements in Kansas versus those states. It should be noted that the amendments in no way dilute or change the responsibility of the Kansas Insurance Department to supervise Kansas life insurance companies, including their investment activity. Security Benefit has discussed the bill with the department, and they have no objection to it. In fact, we're not aware of any opposition to the bill. Thank you for the opportunity to be here today, and I respectfully request passage of the bill. I would be happy to answer any questions that you may have.
Chris, thank you very much. Senator Gossage?
Thank you, Mr. Chair. Thank you for being here, Chris. And this chart is very helpful. I appreciate that. With the department not having any objections, I can imagine that when you said these were outdated, when they were first written, it was to protect financial stability of the company and to protect consumers to make sure that the company can still pay out on life insurance. So it seems as though no longer needed in this particular case as to investments. Is that correct?
Yes, I would, yes. And in general, we think that the remaining provisions that will be in the bill, the limits, the 25% for preferred, 20% for equity, and then in the equity statute limiting the overall percentage that you can invest in any one issuer to 2% of admitted assets are appropriate guardrails to keep in the statutes.
You just answered my next question. Thank you very much. Thank you, Mr. Chair.
Committee, additional questions? Senator Pittman?
Thank you. I just have a few questions, Mr. Chair. Have you talked to any other, it seems odd to be the only insurance company that's seeing this and bringing this forward. Have you talked to other insurance companies and found out if they, I mean, there's no other proponents. It seems like you're kind of going on this on your own. But there's a lot of different companies out there that could benefit, or there's associations, and they've not weighed in. And is there a reason why there's nobody else weighing in on this, to your knowledge? Is it just...
Well, I would say a couple things. One, these particular statutes apply only to life insurance companies, so it doesn't pertain to property and casualty. And the other is that there just really aren't that many life insurance companies in Kansas, Security Benefit being the largest. And so, frankly, different insurance companies have different investment philosophies and approaches. And so, but I guess the direct answer is I'm not sure why others, have not expressed an interest.
No problem. When we take the caps off of the equities, I guess the inherent thing that happens, the correlation is that our investments become riskier, right? I mean, I think you'd probably agree with that, right? That's
to some extent, but not completely. I mean, for example, in both the preferred stock statute and the equity stock statute, there's a requirement that the issuer be investment grade. And so I wouldn't necessarily say that just because it's not investment grade, that the risk is that much different between, you know, a company that's rated just below investment grade and one that is investment grade. You know, for example, companies that, one example would be Tesla. So very large, well-known company. I'm not saying it's a good stock or a bad stock, but it's a very large company. Doesn't happen to be investment grade. So you could not invest in that company under these two statutes because of that.
Right. And I think that's the intent of some of the original provisions. I'm not as familiar with. I'd love to dig into some of these numbers that you've presented to us. It does look like we're using New York as kind of a model state in terms of the pieces that you've picked out in terms of that graph because of the.
I would agree.
That it's not often that Kansas looks to New York, you know, as a.
It is, no, it's not. And I would say a couple of things in that regard. New York has, you know, probably more life insurance companies domiciled there than any other state in the union. And their insurance department is one of the most difficult regulators to deal with in the country. And so if they've, you know, seen fit to allow up to 20% of admitted assets in equity securities and haven't had any issues with it, seems like a reasonably good endorsement to us.
And then it seems like the one thing that I do see that I would agree with on the outdated, you know, I think provisions, whether they're 15% or 20%, aren't necessarily outdated. It's a philosophy of policy of how much risk that we would try and govern into the process. But I do see that there are some numbers that have been sliced out in terms of the minimum assets, I think it is. Something like $1 billion. It's section, I don't know if you have in front of us, but the provisions of subsection B shall not apply at the time of acquisition if the entity has net assets of 10,000 or 10 million or more, net worth of 1 million or more. And then there's another area with an aggregate market value of 500 million or more. Are those the pieces that in particular, I mean, anytime we put numbers in statutes, I feel like they can get outdated. That I might agree with.
Couple things. Yes, so those particular, I'm looking back here at my notes. Let's see. Yeah, that's, I believe that's in 42B07, where it requires that the issuer must have paid cash dividends for each of the last 3 years and had earnings for 3 of the last 5 years prior to the date of the investment, unless the insurer satisfies certain net assets, net worth, and aggregate market value tests. And so there it's an either or. If you've paid the cash dividends for the last 3 years, then you don't have to satisfy those other tests. If you haven't, then that is another way sort of around that requirement, is to satisfy those tests. But the other thing that you mentioned is, you know, a risk issue, and you know, certainly there is risk associated with equity investments, but risk is a function of time. And if you need your money in, you know, a week or a month or 3 months, the stock market is, you know, no place to invest your money. But insurance companies, particularly life insurance companies that sell primarily annuities like us, we have very long liability profiles. So, you know, an annuity contract is designed to pay income to you for your lifetime. And so our liability profile is very long. And so we're not needing these assets in 2 months or 3 months or 6 months. We're needing them in 10 years or 12 years or 13 years. And over a long period of time, I think history will show that the you know, risk associated with investing in equities is you know, manageable and not that great.
Thanks. Thank you, Mr. Chair.
Senator Fagg.
Thank you, Mr. Chairman. Also, thank you for your presentation, Chris. I was wondering on insurance company investments, outside of, we've been talking stock here, outside of that as a whole, what do you invest in? What's the largest percentage of average life insurance company invests in?
The majority would be fixed income instruments of various types. Could be debt instruments of, you know, American companies, securitized debt instruments like residential mortgage-backed securities, other types of mortgage securities. So primarily fixed income instruments of different types.
Committee, are there additional questions? Seeing none, thank you very much, Chris.
Thank you very much.
Are there any additional proponents that would like to testify to Senate Bill 336? Any neutrals? Any opposition? Seeing none, we will close the hearing on Senate Bill 336. Committee, that is all we have for today. We will have a couple of hearings tomorrow, and then on Thursday we'll have another hearing. So with that, we are adjourned.